Hello and welcome back to DEBAKEY CV Live, Sisterhood in Surgery. I'm Linda Lay and my co-host Palma Shaw. Today we're bringing back the financial wellness topic, ensuring your personal financial stability as a surgeon in 2022. And our guest, we welcome back. They were our guests last year and they were a hit. Paul Smith, who's a partner financial advisor at Physicians Resource Services, and Dr. Alan Dietzick, who is the network chief at Danbury Hospital and a clinical professor at the University of Vermont College of Medicine. So I'll start with Paul. And remember, this is a live show, so if you have any questions, join by web, go to pollev.com and enter DEBAKEY, or text DEBAKEY to 37607 and text in your message and we'll get them answered. So Paul is a partner with Physicians Resource Services and a financial advisor with PRS, a member advisory services network, LLC. He has spent the last 14 years helping physicians transition from residency to practice, focusing on personal, business, and estate planning for physicians. He's a graduate of Texas State University with a bachelor's degree in psychology. He has also completed the extensive studies necessary to earn the Certified Financial Planner, Chartered Financial Consultant, and Masters of Science in Financial Services designations. Throughout the year, Paul travels to different institutions speaking on the basics of finance and insurances to help better educate and prepare residents and fellows for their financial path ahead. He is dedicated to the vision of Physicians Resource Services of better planning, better doctors, better families, and he gets up every day working towards this mission. He is actively involved in the community through his volunteer work and service on the Community Action Board for the Helping Hand Home for Children. He's married with 2 girls, Nyla and Hazel. Welcome, Paul. Welcome back, actually. Oh.
It's my pleasure to introduce our second guest, Dr. Alan Dietzick. We are so thrilled to have him back by popular demand. Many people wrote in, bring that guy back. So here he is, front and center. He tried to make us wiser, Linda and I, in our careers with respect to investments in finance. So he's the vascular and endovascular surgeon and distinguished fellow of the Society for Vascular Surgery. He trained in general surgery at the Long Island Jewish Hospital and then did a vascular fellowship at Montefiore Medical Center in the Bronx, New York, under our mutual mentor, Dr. Frank B. He served as the chief of vascular surgery at Danbury Hospital from 2000 through 2017, and now is the network chief of vascular and endovascular surgery at Nuance Health. He holds the Lyndon Stephen R. Cohen Endowed Chair in Vascular Surgery and is a clinical professor of surgery for the University of Vermont, Larner College of Medicine, and the medical director of the non-invasive vascular labs for Nuance Health. His leadership positions are numerous, including past president and founding member of the Intersocietal Accreditation Commission Vein Center Division from 2015 to 2017, and past president of the Society for Clinical Vascular Surgery in 2017. He is the current treasurer of the Eastern Vascular Society, secretary of the Frank J. Veith International Vascular Society, and chair of the American Board of Vascular Surgery. He's a reviewer for a number of our premier journals, such as the Vascular Surgery Journal of Vascular Surgery, Vascular and Endovascular Surgery, and former editor of the Venous section of the Vascular Specialist, our official newspaper for the Society for Vascular Surgery. He has authored multiple book chapters and publications in peer-reviewed journals and given numerous national and international presentations. Welcome, Dr. Dietz. Linda and I value your seasoned insight into this important topic.
Well, not too seasoned, but thank you.
Young and seasoned.
There you go.
So I'll lead off with the first question, and we hope that the audience sends in some interesting questions as well. How much should we be saving for an emergency fund? So we get our salary, we have a variety of expenses, and may have still some school loans. I have 2 children, I run a household, but I know I need to put something away. How much do I need to put away? And then what if I have other bills? How much do I leave on my credit cards rather than pay the bills or put money away? What are your thoughts on that?
Paul, you want to go first?
Sure. So this number is going to vary for everybody, obviously, because of different cash flows, different incomes, things like that. And many have probably heard of this rule of thumb that, to set aside or have 3 to 6 months of their income. So if you're looking to come up with a number that might be a little bit more specific to your situation, I think that you can narrow that number down to 3 to 4 months of expenses. Think about it that way. And then, you know, why 3 to 4 months? Because when you stop and consider the things that could happen that would trigger the need of emergency savings, the largest financial issues really come from loss of income from disability, death, or some other kind of major event. But if somebody has taken the right steps to secure their disability or life insurance, 3 to 4 months would generally kind of cover that time frame. The interesting thing here, I think, is I don't actually love the idea of having an emergency fund, and simply because I think if an emergency actually happened and you could use a credit card, right? You could loan against your 401k. Now, they're not ideal sources, but the reality is that in a true emergency, what difference does it make? You're going to get the money that's required. You'll go do it. Now, the thing here is that I think emergency, when you think about it, why I don't like it, because it can convey this idea of negativity and it makes it hard for some people to peg this right number, because I've had these discussions. So you go, well, what's the emergency? How long will it last? So, much different than that, I would say, why don't we encourage to think about it as having a buffer account? And that is a combination of maybe expenses and then this feel-good number. So I spend a little bit more time around this. For example, if my expenses were, say, $10,000 a month, I should probably at least start around that $30,000 to $40,000. That's going to create that expenses number. But that may not feel comfortable enough for me. Right? So I think this is where adding in your number, your buffer amount, can actually account for your individual personality, right? And here is the question, right? What is this extra buffer account? And that's why have it. You have the emergency portion. That's a number that's there. But there's also this number that just makes us feel better or more secure. And this number, I think, is very important. Why? Because we also have this secondary thing here where we have to invest appropriately for the long term. And so it's not necessarily an emergency when the market takes a 20% dip, but psychologically, it really can feel that way. And frankly, having enough around this number, this buffer number, seems more important to me, because the reality is that very few people will have this quote unquote emergency pop up in their lifetime. And it require the use of you depleting this particular fund. So if we think about it traditionally, that's highly unlikely, but everyone will experience economic cycles and downturns at least a few times in their lifetime, right? So if I can have a number in an account that I can experience economic cycles and downturns that make me feel like, hey, I can endure this, I'm okay. That's the more important issue I think that we can be considering. And so now what I've been able to do by having that number is create space and peace of mind for your long-term investments. And so again, I think that if we take time and think about it, arguably more harm can come from diving in and out of the market, right? Because I feel intrinsically very emotional about that. It's what's going to happen during these economic cycles, which most of them are very normal, right? Or what if it causes me to invest too conservatively for my retirement? Right, sacrificing that potential growth because I don't have enough in this buffer fund or this area to feel comfortable enough to endure that long term, or that downturn. So I think in theory, emergency fund is important, but in practice, I think having this idea around a buffer fund is going to be more critical. When you pull that out and go, okay, well, should I have credit card debt or this? It comes down to two things: interest rate arbitrage and psychology, right? If you have a credit card with 0% interest rate and you don't mind making the payments, then that's okay. I think having the cash on hand may feel better. But clearly having credit card debt at 16 or 24 or whatever percent, when you have a savings account that's only earning 1 or less, it's not good. So especially when you can utilize that credit card during an emergency, as I previously mentioned. So really kind of comes down to your feel, I think, on this one.
We already have a question. Dr. Dietz, did you want to make a comment before I ask the question?
I was just going to say that I agree with a lot of what Paul said. You know, and something Paul and I were talking about right before we came on to the webinar is that, you know, as you spend so much time training to finally to get a real income, that you may be very tempted to spend your little hiney off to try to catch up to your friends or what you perceive you should have for having delayed the gratification of having a real income. But I would tell you that while you deserve some of those things, you really don't want to put yourself in horrible debt. Having a safety fund, I think, is a good idea. Probably somewhere in the range of the 30 to 50,000 mark is always what I've been told. But that's not an insignificant amount of money, especially when you're starting out. And it's kind of hard. I always found it hard when I first started out to have a large amount of money sitting in a bank account making nothing, rather than having that money doing something and working for me and making interest. Now, where you put that money is really where it becomes a little tricky. If you have all your money invested in stocks and you're going to use that as your safety fund, well, the risk there, as Paul alluded to, is that emergency might occur when the stock market is dropping like a rock, and that can hurt. So you need to have a certain number of liquid assets put aside, but maybe not necessarily sitting in your bank account doing nothing. Likewise, I would say never do anything on margin. And I say that from experience. You know, when the stock market is going up and things look great, and you say, you know what, I could use a little extra money, I'll take money against those stocks, because they're of course going to continue to go up, just as the value of your house is going to continue to go up until it doesn't. And then when something bad happens, you wish to God you had never done that. So don't do it.
So the question is, sounds like Paul might have different opinions to Dave Ramsey, no emergency fund.
That's not at all what I said. I actually said to think about the money and in a combination of sorts. There still is money there, but to tag it solely for this idea of an emergency, which most likely, again, statistically, won't happen. But the market downturns will. I've watched and worked with clients and their behaviors, right? That rarely it happens that, oh, I got to get into this because X happened. Like the air conditioning unit went out, the car, you know, people in accidents. But the big ones, they happen. We plan around those, but you typically would have something that kicks in, you know, your insurance, et cetera. What I have found, just again, my experience, is that you have an emergency fund. I'm just encouraging people to think about it characteristically a little bit different.
Oh, Paul, we can't hear you.
We lost the audio.
Paul.
Okay, is that better?
Oh, wait, yeah, you broke up from, yeah.
Okay, sorry about that. So I think that having an emergency fund is good and needed. The number I'm talking about in a buffer actually ends up being more than typically what maybe a Dave Ramsey or somebody might encourage. Why? Because there's something above the traditional emergency amount that will allow me to feel better, because I go, hey, that's a good number and I can endure an economic downturn. While not all of us will have emergencies. My point that I was trying to clarify was that we will all, as we're investing for this long term and putting money in the market, we're going to see market cycles. And I rarely see people that feel really great about those and go, oh, that feels awesome to see the market down. My 401k is taking a dip for 20%. Let's do more. It really doesn't work out that simple. But if you feel like, hey, I have this number and I'm good, my job's stable, that's the call that I usually feel, right? The call I usually feel is, okay, we have this, so let's walk through this. Has your job changed? Has your specific situation changed? Has something happened that would be contrary to the plan you put in place? Nope. Okay, we have this, and if this happens, then this. So that's really more specifically about what I'm saying, is that those things will happen. So having the comfort in knowing that you can make it through an economic cycle so that you don't jump out, that part can be so much more devastating, because rarely do you know when to get back in. Never, right? And that's the truth, is you never know when it's a good time to get back in. And so much is lost by doing that, playing that game, because you didn't feel comfortable by having enough in an emergency. Now, be careful, because I think Alan alluded to this as well, is that having too much can also be this double-edged sword thing, where I've had clients who have too much money. In my humble opinion, why do you have $1 million in cash? Well, just in case. Okay, well, now it's exposed. It's not earning any money. I'm paying taxes on the smidgen of growth that I get. We also have to be careful of not having the money invested appropriately for the long term. So again, everybody is uniquely different here, but there is a number that is comfortable for people to have. So I try to dial into that, and then above that number, we can think about deploying it for midterm or long term. Hopefully that's a little bit more clear of an answer.
Yeah, no, I just, I thought that was a funny comment with Dave. Dave Ramsey's so like black or white, right, on all his rules.
Right.
So
that's not me.
Right. Well, and that's not finance in general, really, but anyways. So the next question actually focuses on college funds. So logistics of a college fund for your children. Is there a max amount to put in, and what are the restrictions on, like, just sort of a general how to, I guess, Paul and Alan, and what if at the end they don't go to college? Then what happens with the money?
Adopt a child that you can send to college. I mean, that's the answer.
Or go back to college yourself.
Right. There are certainly plan maximums. They're going to vary by state. So each 529 operates a little bit differently, but they range from a maximum per beneficiary that you can have per state, and for anywhere from 230 to about 550,000, right? But then you also have annual contributions. While there's not a limit on how much you can put in annually, there is IRS rules around this. So this year it's $16,000 per donor per beneficiary to qualify for the annual gift tax exclusion. So that's important to note, because if you go above this, then you just have to file it, and there's could be some annual gift tax issues, but generally we're not up against that. If you want to, though, and you have a bucket of cash, you can fund up to 5 years. You just can't continue to fund it for another 5 years, but that might be ideal for a grandparent that has excess cash that they want to donate to their grandchild. Present value of current dollars is going to be much more impactful by putting it all in there today versus over the next 5 years. So that could be a good decision and a good approach as well. If your child doesn't end up going to school, this is kind of an interesting age now. You can end up going the same route that y'all did, where you have undergraduate, graduate, medical, et cetera, and then have a lot of educational expenses. Some people can bypass that completely. You look at tech, and a lot of my sister specifically went a couple of years of school and says that, I'm out because all the new stuff, the coding is just years behind what they're teaching in school. So if that's the situation, it doesn't mean that your attempts at providing some sort of resources for your child were for naught. You can change the beneficiary if you have multiple children, but it actually could. Let me throw this out here. In fact, what about a family education endowment, right? So if you have a smaller family, this may not be ideal. And I know that for saving for college is a big enough task in itself for a lot of people. But for others, it's not just a possibility, it's actually a priority. right? So they'll sacrifice, and I would say be careful of that too, because if you haven't done enough for yourself for your own retirement, that would be something you want to talk through. But if your family looks more like the folks that say, look, education is super important, whether they do or don't, it's really important. I had debts, I don't want my child to go through that. You can continue to max out these plans, and guess what? You can change beneficiaries. But in addition to that, you can actually change ownership. And so there's nothing currently in tax law that prohibits you from transferring ownership at the death of the current owner. If I have one and I use it for my daughter, or I don't, and then she goes on to have a family, I pass away, I can have that ownership transferred to her. And all the while, this account can continue to grow tax deferred and be used for educational expenses. So it can fund a lot more than just my college, or my child's college, could be the grandchild. So there's more flexibility there than not. Worst case scenario, you stuck money into an account, it grew tax deferred, and then you pull it out and you pay ordinary income tax on it, and if you give it to your child and they have it against their tax bracket, it's generally lower than yours. You add on the extra 10% penalty, that's going to be the worst case. You could still use it, potentially even in an emergency situation. So.
Wow, people have a lot of questions about the emergency fund. What is going back to what is roughly? I know, what is roughly the cost of different fields in medicine to save for? I guess that question is like, I guess different specialties. Would that matter?
For the emergency fund?
I'm assuming.
Yeah, I think it comes down to income, expenses, not specialties.
Right. Yeah.
I think it's really a matter of expenses.
Right. It's what you spend is what you need to save for.
Let me actually, this week is going to be jumped down so we can talk about it later, because I know that it was going to be part of the discussion. But that's actually an interesting question. So the specialty. So I would say that it sort of depends on how much your particular work or specialty is reliant upon production. And that's going to get into how much people can be affected by downturns or, loss in the ability to work. So if you have a specialty that is maybe in private practice and you have overhead, you're carrying your work expenses. I am a part owner of my practice. I carry a lot more in I won't say emergency, in buffer, because there could be fluctuations. So if you have less of a steady paycheck and things like that can impact, not completely obliterate, but can impact your cash flow, then maybe having more on hand could be a good idea. I don't know that, again, it's by specialty, but just the exposure to how the amount of work can impact your income.
Palma, did you have questions specifically on college fund? I know
my son is going to college in August, and I have some money put away in the 529 plan. One some for my daughter, some for my son. But I guess I was just trying to figure out, when do you start? When do I need to start withdrawing that money? And let's say it may not be enough to pay for all 4 years. Would you use what you have up front first and then take loans out later? Or if I can get a good loan, would I take a loan and do a 50-50 contribution to that?
Mm-hmm. So for your individual situation, I would always say that just there is really no black and white. I mean, everybody's an individual in what they need in their situation. So the account is there, whatever you've been able to set aside. It's really, in my mind, it's set aside specifically for college. So I think you go ahead and use what you have on the front end so that you reduce the risk of market fluctuations. You don't want it taking a dive and now you have even less. So you could accelerate that and then just apply cash from either a savings account. So if you have a certain amount now, start using that and deploying it for school. And then I would say encourage you to continue to set money aside. Now, it may or may not continue to go into that plan. You might put it into just a savings account or a brokerage account, something that's not exposed, because again, your child is at school time frame, so don't want the risk of loss with that. Why you may want to continue to put it into the 529 is not because you get a federal tax deduction, but depending on the state that you're in, you could get a current income, a state income tax deduction. So it's not so much that you actually get the deferral and growth because you're right there at that window, but there could be some money there that gets shaved off just from what you owe on your state income tax, and it just sort of becomes a flow-through account for some of those dollars for the later years. But if you can't do that and you need to take a loan, here's here's what I always say: be on track for your own retirement first. This again kind of comes down to my personal opinion. I have had folks that say, nope, my kids are more important, and that's okay. I'm not here to change minds or opinions. I have my own too, and I would just say that they give loans for college students and not for retirees. Mm-hmm. Right. So just make sure that you're on track for your own first, because the last thing, it comes to being a parent, we want the best for our kids, but at the same time, I think we also don't want to be reliant upon our kids and later on in life. And if I don't have enough and now my child has to come in and help me supplement my own retirement, we have to be careful of that. So take the loans if necessary, and you never know. They may go on to become a physician as well and have forgiveness programs, and nobody needs to pay that back, right? So I think you use what you have accessible to you and try to do that without sacrificing elsewhere.
Alan, what did you do? Looking back, how would you tell your children? I think you're done school, right?
Well, hold. There's a question which I think would be perfect for. The questions are just like coming. What are your feelings to make the child work for their education to where they feel more accomplished when completed, compared to it just being handed to them by a college fund?
Well, that's a very complex question, and it depends upon how you were brought up and what your feelings are about that. And if your child can handle working and going to school and they want to do that, I think that's great. If your child says, listen, I really can't handle that, then you're going to have to make a decision. And, some parents say, listen, if you can't handle that, go part-time. And that's fine. Everyone has a different philosophy about how their child's education should be paid for, and I don't think there's a wrong answer. Mm-hmm. My kids did not work and for their education. I paid for it. I feel that if, in fact, you have to take loans, my personal feeling is that those loans should be taken by your children and not by you. Mm-hmm. It is their future. And it doesn't mean that if you have the means, that if you decide to pay back your child's loans, no one's stopping you from doing that. You can still do that. But when you talk about invested, I think when your child takes that loan, they are invested. And when they want to take that extra year to get a master's, or they decided to goof off and maybe take a major in college that they knew was not going to serve them well, or that they were going to have to take additional education, if you let your kids know that, listen, you're going to have to take some loans to complete your education, they might think differently about that. This is not all fun and games, or maybe they will. So that's my personal feeling about that. And then there's the whole issue of, this whole thing with loan forgiveness. Who knows what the future is going to bring? And I've been wondering and have wondered, what about all those parents that struggled to pay off their kids' loans to go to college, and then in one fell swoop, the loans are eliminated for those that still have outstanding debt? I don't know how that's going to work. I don't know what's going to happen with it, but it seems to be an issue which is not going away. So who knows what the future is going to bring? I personally would say, let your children take the loans and you can pay them back if you want to.
Mm-hmm.
The next question is, are there some financial breaks I can apply for just for medical school? That I do not I don't have the answer
I'll
to that.
tell you, I was with a resident the other day, interviewing him for a job, and I assume this is true, and he told me that he has been compliant with paying the interest on his loans, and that if he continues to do that for 5 years, it must be at a not-for-profit hospital. It cannot be in a for-profit job, or in an area which requires healthcare, a socioeconomically disadvantaged area, that his entire principal loan will be forgiven.
Wow.
And that this is a federal government program. Now, I would check up on that. I had never heard that before, and I looked at him and I said, what? And he said, yes. He said, so I am motivated to be employed at a not-for-profit hospital, which is why he asked me if my hospital was not-for-profit, if it was for-profit.
That I've never heard of that. That's
Neither have I. But
So
I'm
you're
assuming
saying that he was a medical student or a resident already?
he was a resident already.
Mm-hmm.
He was a fellow, and he came to look at a job, and he said to me, is this a not-for-profit hospital? And I said, it is, but why do you ask? And he said, because if I pay my interest on my loans for 5 years after I finish, after I am employed, that the entirety of my loan will be forgiven if I'm at a not-for-profit hospital. I was astounded by that.
I am not familiar with a program like that. The standard program and that may be part of their understanding or part of the story that you didn't get from it. I don't know. I can't speak to that. I know that the PSLF program, Public Student Loan Forgiveness Program, is still out there. It's 120 qualifying payments. So if this person had just finished residency of 5 years and started right after they got into school or into their residency program, had completed 5 years of payments or 60 there, and they'd have 5 left theoretically, right? So the fact that it would just be interest only, they calculate, it depends on the program. There's 4 different programs. We don't have time to get into all of them today, but there's different programs, none of which are really going to be interest only in theory, but you are paying such a high amount towards the interest that you're not knocking down any of the principal. And I think that may be somewhat lost in interpretation, is I'm paying only interest, which happens because you're accumulating so much that you're not actually paying anything towards principal. So it's not that there wouldn't be principal applied, it's just that your payment is calculated to be so low because the resident fellow stipend is low in the calculation of what you need to repay. I don't actually make a dent in that. So that program is still around. Again, you have to be careful of it because we've seen a lot of people who have become dissatisfied with the fact that they get to the end, they haven't done the right steps and apply for the forgiveness, and then the answer is, well, you don't qualify, you hadn't done this, this, and this. So it's still out there. People can be forgiven for it. Does have to be a qualifying employer, right? That's a big one to be careful of, because sometimes your paycheck comes from somebody else, not the actual qualifying employer, 501c3, that kind of thing, right? So you could be technically employed and paid by somebody who is a not qualifying employer, and then all your payments didn't qualify. And then you get to the end and you think you did, and that could be very, very disheartening. But that one's still out there. So check that box, make sure that you're turning in the annual certification that you work for the employer, things like that. And so those programs are still out there. That's a little bit different. Each of the other programs that are federally out there, like the pay and the repay, those also have some forgiveness around them, but they're typically longer, 20, 25 years. And any forgiveness that is on the back end of those is typically going to be taxable. One of the main advantages of being able to qualify for that forgiveness, this is going to, if you didn't believe that one, Alan, the big one here is that when they pay that off, assuming that you've gone through and you've done everything, then the amount that you receive in relief is not taxable. So that's a big deal, because in the other programs, if you pay them that amount that you receive that's been paid off or forgiven, or even if you go to work for an employer, say for example, and we're seeing some of this too, where an employer will say, look, we'll pay you X salary, but then on top of that is sort of an extra benefit. We'll pay X number of dollars towards your loans every year. Right? Now that gets counted as what we refer to as imputed income. It's taxable to you, like you actually received it, but you didn't, and then so it increases your tax burden. It's still better than paying 100% of your loans back, but just know that that kind of exists. So under the PSLF, it's a really nice thing because that's not a taxable situation, so it's nice.
Well, I would certainly check into it, because as I said, I had never heard of this, and I seemed like a pretty well-informed guy. So who knows? Either that, or he's going to be a very shocked young man. but as far as, I think the question really centers around paying for professional school or medical school or law school or whatever. And again, I think that it's really it's hard to go to medical school and have another job. I don't think you can do it. I don't think you can do it in law school either. Although I guess if you extend it out for a number of years, you can. But I think there's nothing wrong with having your children take a loan for these professional schools, especially since you would hope that when they finish, they're going to make a decent income and may be able to help or paying part of that loan back or all of that loan back.
This is great. So we'd like to move into the question about maybe a little bit about the whole life and then that long-term care insurance, because I know a lot of people are wondering, is this worth it? I have patients that have it, and I have others that don't, and the ones that have it seem to like that or be glad that they invested in that. So.
Sure. So, long-term care planning in general has just become a much bigger factor in personal planning than it ever has before. And so when this started years ago, and when you think about just insurances in general, it's relatively young, 30, 40 years ago. But when they first came on the market, they were very rich policies, very good, kind of like the way that disability policies were back in the early 90s, very nice. They were priced by carriers across the board with expectations that they would have portfolio performance, right, that would be similar to previous years. Claims rates, lapse rates, meaning people drop policies, would be very similar to around this disability insurance. So they looked at this as a satisfying a need, but here's how we're going to do that. The problem is they were wrong. Across the board, unfortunately, carriers mispriced these original policies, right? They experienced what I would refer to as this perfect storm, where interest rates did not continue, but rather they continued to slide, reducing performance in their portfolio. Now, this is really important to a carrier because they have to have the ability to forecast what they're going to need and be able to pay future claims. The other factor was that policyholders were not dropping these policies. And in addition to that, the claims were high and the usage was very high. People were depleting these policies, so they were heavily used. And because of this, they had to come in, and everybody at one point or another increased premiums on what they call in-force business, anywhere from 30, 70%, things like that. This is all important to understand because the evolution now has become where these individual standalone long-term care policies, why they have the ability to be customizable, that's nice. I can really create it around my situation, have become much more expensive. And so it pushed a lot of people out who were considering getting one of them. But it's created a rise and evolution in whole life policies, which I will tell you right now, Ramsey and many others hate these things. But the reality is true is that this thing, I'm just not going to be one that subscribes like a one way or the other on these things. I think that there are products out there that for some work really well and for some are the worst thing that they could have done, right? That's just the way that it is. But now they have them where you can add this rider. Typically they're called like a critical care rider. Where they can work much like a long-term care payout. Now these are more attractive because whole life policies have been around for a much longer time. The pricing on those is much more stable. They can guarantee that, so people like that. The other thing that they like too is that these new hybrid policies sort of wash away the concern, well, if I pay into a long-term care policy for 20 or 30 years, depending on how long you have it, and I pass away, then that money evaporates because it's not an inexpensive policy, right? So having now a policy where if I use it for long-term care, that's great. If I don't and I pass away, guess what? Somebody gets that benefit. So it's less of feeling like there's wastage there. And so that's always been a little bit of a concern, dying without being able to use that. Even though, again, statistically, when you're 65, 70% of us will have this need right now for some sort of long-term care. So, when you go out and you want to look at doing it, there's just not a ton of carriers in this field. You're going to find a few strong ones that are left. Very few standalone options. Most of them are popping up to have this whole life policy with the rider attached to it. If you're going to plan on it, though, I would say, start with the averages. Nobody wants to be overinsured and waste money, but you don't really ever want to overpurchase. So start with the averages. What do we know about long-term care usage and planning? Why even get it? Well, typically you're getting it because you're trying to protect against asset depletion. I don't want to run out of money because I planned on retirement income costing me this much, and now if I go on claim, average claim for people is 3 years. It's a little higher for women, right? 3.7 years on average, men 2.2, but the cost is going to be significant. So if I need that care, it's somewhere between, and again, there's multiple factors in this, where you go, how much, how attentive people are, but $200 to $250 a day. Look for the care to cost anywhere from an extra 40 to over 100,000. I've known clients who had parents, they were funding over 10,000 a month for their care at the end. So that can be significantly draining, and that's why this has become a much bigger issue. I think before we jumped into this, you had asked, is it too old, or should I just cut my losses if I'm 55? And the reality is that it's about half and half. 50% of people 64 and below are still getting policies, and those that are older than that are getting them. You have to look at your situation. Does acquiring something like this do what I need it to? Does it protect my assets from depleting out? Did I want to leave assets to my kids? There's multiple things around this, and to be just perfectly candid, you know what the conversation is generally about? I don't want my kids to have to take care of me. And in my home, my wife's mother, so my mother-in-law had to care for her parents and go over there 3 days a week, experienced that, watched it happen for multiple years, where she took care of her parents. And my father-in-law, her husband, just talked about how much it drained her, and it was like killing her slowly. And again, I'm being quite candid about this because this is what brings the importance, is that it's happening more than we admit. And they didn't have the assets, they didn't have the ability to go even into care. She was giving her dad showers and changing his diapers and his bedding and all this sort of stuff. And for me, that's why I'm 47 this year. I acquired long-term care because I'm like, I do not want my daughter changing my diapers. Like, I changed theirs, right? I don't want them to have to do that for me. So it's a lot about protecting the assets that we may or may not deplete through, but also it's about dignity at the end and having, I want somebody else to do that, right? So it's a great question, but this is becoming a bigger issue for people to plan around.
Alan, do you want to give your personal experience about this?
I think that when to obtain a long-term care policy is something you really should discuss with someone like Paul or a financial advisor. I think there's this sweet spot, they say, between around 55 when it makes the most sense to obtain the policy, maybe earlier, but I think that's the sweet spot because you're not paying for all those years in advance. I do think it's a good idea. I think that, at the time when I was considering it, my wife had a major medical event, and then it became impossible to obtain that policy because then the cost of it goes up way too high because they have all sorts of actuaries that assess the policy and all this other good stuff. So I think it's a good idea to have. I don't know that you need to do it when you're in your 30s or early 40s, when you're, most in need of your assets to buy your kids things and save for college education and pay your mortgage. With regards to life insurance and getting life insurance, it's my understanding that life insurance is still one of the major loopholes for saving because of the way the money is taxed or not taxed, the money you're putting into it, and how you can borrow against that money at a very low interest rate. You're borrowing your own money. I will tell you my advice, Paul, and you can say something about this. If you're going to get insurance and you can afford it, I would say get whole life and not universal life. This is not versus term, but if you're going to make it as an investment, because with whole life, there is a defined premium, and once you pay into it a certain amount, your premiums are taken care of. With universal life, it's dependent upon the stock market and interest rates, and you could be doing great and not paying premiums for a while, and then if the stock market drops like it has now, all of a sudden you find yourself paying premiums again. You don't want to find that out when you're 80 and you think that you have this great insurance policy, and all of a sudden you're paying premiums again.
Right.
Yeah.
Don't let anyone sell you a universal life policy.
Well, we have many questions actually, and only like 10 minutes left, so I'll try to start asking them. Are any high schools teaching financial responsibility? They did not teach it when I was in school. That question I don't know.
High schools.
Both of my children are taking personal finance in high school, freshman and senior
Awesome.
year.
That's really good. Okay, so the answer is yes. How does a resident from a lower socioeconomic status set themselves on the path to financial stability early on during residency?
Boy, that's a good one. It kind of comes into one of the other questions that we were maybe hoping to get to, and that was just being able to even retire early, but to set yourself up. I'm presuming if you're coming from a lower socioeconomic standpoint, and you started. Listen, this is my world completely. Why? Because I was one of 8 kids. I was telling Alan before that we jumped on this, is that we all have our different opinions, but mine is that we worked. Right? As soon as I could, I worked. I started throwing papers at 9. I started bussing tables at 14 and worked and worked and worked. For me, depending on what I'm doing, it's rewarding. But knowing that and working harder also created this ability and this desire in me to succeed. So I would say that if you are there, congratulations. Right? If you're in medical school or you're in residency and you're of lower economic status, to get there, keep going. Because these limitations, I would say that, again, that the American dream is very much alive. It just depends on whether you want to achieve it and work for it. So you can achieve this, just be careful of going out and spending too much. Alan talked about the desire to go out and get something, acquire things, the deferred gratification for your role as a physician, right? I get out of medical school, but then I get a little bit of stipend just to help me live through residency. Let's face it, right? You're still underpaid significantly, but then I come out, I get a higher income, and now I can actually go afford to do some things. What happens for some is that residentiitis sets in. And that's this thing where we look at it and go, I got to buy the house, I got to buy the car. And maybe some of those things are important, but start backwards. Look at your debts. But there's this other thing you've been deferring as well. We talk about all these debts and all these things, a house or or student loans. They're a lot, but there is a bigger one. I may have brought this up the last time we talked too. There's a bigger debt that we all have, and that is a retirement for ourselves. Because the truth is that nobody else is going to fund that for us except us. So we have to consider our own retirement as a debt and take it seriously like that we have to pay that off too. So start by when you get that paycheck, if you can, right? If this is your first paycheck, guess what? You probably aren't used to it. You could probably set aside some money into a Roth. That would be great. A few $100s a month. Just create the habit. So much of what we do when we are working towards the longer term is habit centered. How much I save, how much I spend. Several times throughout my career, I've told people that a luxury once enjoyed becomes necessity, right? This reward system that we set up in our head, that we reward ourselves for doing something, achieving something, and then psychologically, we're going to continue to do that. Now, that's okay if your cash flow supports it, but it just continues to escalate that behavior and that spending. So be careful of that.
Yeah, I would say in those first few years, and listen, I went through it. You get out, and you're now I'm going to get all the nice things I've deferred, and you're depending upon your income continually going up. That doesn't always happen, and at least not the way you want it to. And I would tell you that those first few years, live within your means. Get into the habit of saving. As Paul said, you will never be sorry about saving, and I will tell you, do not get credit card debt. I live that, and it is a bad place to be. You're paying interest on top of interest. It is horrible. So you do not want credit card debt. Pay your credit card every month. If you can't pay it, you shouldn't be spending it. And live within your means those first few years. It doesn't mean you're never going to take a loan, but you want to be in a place where you know you can pay the loan and at the same time still save money. Because that same compounded interest applies to the money you save. And the earlier you save, that small amount of money will turn into a large amount of money. And the later you start in life doing that, the more behind the eight ball you are. If you start now, you will never be sorry you did it.
Okay, what is the return of investment of a medical degree today? Ooh, these are hard questions.
The return on investment for a medical degree. Well, how do you even quantify that one to an answer? Everybody's investment is different. Where did you go to school? I've seen people with student loans or less, and then some that had, unfortunately, we had somebody who decided they wanted to train abroad and they had $600,000 in student loans.
Oh,
what is your specialty that you're going after? All right, so that's a good question. I'm just not sure how to really come down with a quantifiable number.
I'm lost when it comes to insurance. Where can I get a 101 on it? Well, on this webcast is one, but
which insurance? That's the question, right?
Say that one more time, Paul.
Which insurance? Because there's a few different types. And Alan, I think it was you that said, hey, it depends on the timing in your life, right? Don't be looking at all of them right now. Where are you at, and which one are you looking at? So those are, which one? Is there anything in specific?
No, I'm assuming the question popped up when we were talking about whole life, universal life term, riders, those words. So I'm assuming that's what they were asking about.
Mm-hmm.
I don't know. From my perspective, Paul, I had term when I started out.
Mm-hmm.
I don't remember what the cost of whole life was at the time. I remember it was expensive, and I probably didn't want to spend it, or I couldn't afford to spend it. So you start with term, and then maybe as your cash flow improves a little, the earlier you start doing something like whole life, the less it's going to be than as you get older. So.
I don't want to be self-promoting, but this is what we spend a lot of time doing. So I would just say, to be more general, is that to get more information, you can certainly always Google it. The problem is that there's a lot of information, both positive and negative. And that might be the hard thing to really disseminate, is what information should I really be paying attention to? And so to make it easier, if you don't have that much time, you don't want to do that much research, and you don't want to be pulled in a direction, is to talk to somebody who can act in a fiduciary capacity, right? That they're operating from your best interest. They're not completely affiliated with or employed by any carrier, so they're independent. And somebody who really knows about that. And this is actually a challenging thing in our industry. I admit this, because we have a lot of brilliant people on this side, but just like your specialties, there's some people in the financial world that are not as savvy or as well versed in the insurance. So they may be an advisor, but they may be better at maybe this angle of it. Maybe it's portfolio management, maybe it's estate. They don't really know disability insurance to the depth that you need for your specific situation, or term and whole life and things like that. But everybody is different. Timing is different. I think that the products can work, all of them we've talked about, if they're looked at for your specific situation, not the person. And this is the problem. I don't like that they're sold, right? Rather than just looking at it as a tool, they all can work for you. But guess what? They can also work against you. So I like the question because it's important. I think people should do their research.
I would agree with that.
Yeah. And I guess we're running out of time. And, this is sort of similar. Is there a source of information about everything talked about today? And I mean, I remember last time when we talked about finances, Paul, you had a big, push for, you have to be like actively involved in your financial future, and do your own research, because I think a lot of us, we're so busy operating, we're so busy doing this, building our practice, kids, family, the house, that we don't take time to really look at our finances in detail and really know what to invest in. So I think the more you put time into it, the more you kind of learn about it.
That's absolutely true. The what you put in, you get out.
Yeah.
And for some people, they know they don't want to be the experts in this field, and that's okay. That's why people like me, if I can even say that, exist. But that's also the same reason why y'all exist. Like, thank God for everybody that's on this webcast and listening to this, because I like to donate blood, but there's no way I even want to look at the needle going into my arm. I have to turn away every time, because that is how much it bothers me. So thank you for everybody that does what you do.
Paul, here's a question for you that I think everybody would like to ask. How do you find somebody like you? Because I will tell you, when I was much younger, finding somebody that was knowledgeable and trustworthy, and trustworthy is a biggie, because you don't know what that financial person is getting back for the advice they're giving you. And I can tell you, I was in a situation where I was given advice based upon what they were getting as a result of that advice, not as my fiduciary, although I'm sure they could make it look like they were my fiduciary. So how do you select a financial planner and know that they're going to act on your behalf? What should you be researching to find that person?
I think there's more research or resources available for that. I am trying to remember the name of the group that is actually trying to make that easier, and I am not remembering. But so for everybody on the call, very quickly, there is, much like some of the acronyms and designations and additional training you can do, in our field, I would say that the CFP marks, or the Certified Financial Planner marks, are the gold standard. I'm not trying to advertise for them. I'm not saying that you can't get educated and be a brilliant planner, but the stringent expectations that comes with that, and being under that and holding those designations, comes with this fiduciary capacity. So that's step one, is you can do that. Step two is ask a friend, right? How long have they worked with somebody? What do they like? What do they not like? Is it too much to say that, hey, if you want to reach out to, I'm happy to have a visit with you. I don't want to do that, but at the same time, we're happy to guide you in the right direction if necessary. But start with understanding what the background of your advisor was. Do they have those marks? Ask them the question directly. Are they a fiduciary? Right? And then don't be afraid to ask them, how do you get paid? Because, it's not bad to receive a commission, but if that's all that they're based off of, it might mean that they have different motivations, right? If they receive a fee only, they might be limited in helping you in other ways that put more work on you. So, again, I don't subscribe to the all or none philosophy. I think there's a way to balance in the middle and still do the right thing for people.
Well, it looks like our time is up. The questions were just flying in. So any last minute comments? Paul, Alan, thank you for joining us and giving your insight on everything. I think now everybody's worried about long-term care insurance.
Oh.
No, I have a much better understanding about the emergency fund, thanks to this show. Great.
You'll all do very well, and good luck to you all. Just be smart with your money, as smart as you can be.
Yeah.
If there's that many questions, I just say that when are we doing this again, right?
Yeah, I know. Well, it's very so we might do it like twice a year because there's been a lot of questions actually from sounds like our younger audience about just learning personal finances, loans, things like that. So maybe we'll do one on that.
That would be great. We're seeing a lot of the younger generation much more involved in information seeking. It's good.
It's important.
Thank
All right.
you very much.
Good night, y'all.
Good night.
Bye.
Thank you.